I'm Matt Bouchard with REIT.com here in San Francisco for REITWorld 2013, NAREIT's annual convention for all things REIT. I'm joined by Paul Curbo, Portfolio Manager with Invesco Real Estate. Paul, thanks for joining us.
Thank you.
When we spoke with you this past summer, you said that you had zeroed in on the apartment and regional mall sectors as key investment targets. Are those still on your radar screen heading into 2014?
Yeah, we still like both sectors. I think they offer a couple of different things that are beneficial to a portfolio. One being that they offer above average growth characteristics over the next several years. I think also they do trade at discounts to the underlying asset value. I think for the apartment sector, it's been a bit of an underperformer as there's been new construction, and that's tended to moderate growth, internal growth. But I think as we move into next year and the upcoming years, I think there'll be other sectors that will also be experiencing new construction. I think also there are development pipelines and redevelopment pipelines that the apartment REITs have that will prove accretive to growth over the long term. For the malls, it's really a story of no new construction within the sector, and so pretty compelling growth characteristics that don't have the supply risk that we may be seeing in some of the other sectors.
And kind of the overriding elephant in the room here at this conference and in a lot of conversations is obviously interest rates. How are the factors dealing with interest rates impacting your forecast? Go ahead.
You know, we don't know the path of interest rates, but I think it's probably helpful to look at where we've been and where we've come from. We've obviously been in an environment of declining interest rates. That's proved beneficial to REITs overall in terms of asset values. It's proved helpful for companies in terms of acquisitions, and most importantly in terms of refinancing debt. Now, if we get a spike in interest rates, which we're not forecasting, but if we do, all those things that have been so beneficial kind of go in reverse. Even if we don't get that spike, if interest rates are fairly static at this kind of range, I think some of the benefits that some of the companies have derived are probably going to be less significant going forward. So we would rather look at companies that can produce internal growth as opposed to be reliant on low interest rates.
And what do you envision as the key investment story in the REIT landscape for the coming year?
I think it's growth. I think, where are companies going to get growth? I think a key for stock selection is, once you reach a kind of peak level of occupancy and you're really relying upon the market to provide rent growth, is that achievable in your markets? And so I think having a good understanding of where companies are going to achieve their growth. I think also balance sheets are important. That really hasn't been a driver of performance over the last several years. It's almost been like the more debt you have, the better it is. I think going forward, questions about, is your acquisition pipeline pre-funded? Is your development pipeline pre-funded? Do you have to source equity for that? Are you relying upon the capital markets to really deliver your growth? I think those are key considerations. And so for us, when we look at portfolios, I think internal growth becomes a much bigger driver of performance.
Paul, thank you so much.
Thank you.
For more on this and other REIT news and analysis, be sure to visit REIT.com.